First of all, we at Bonadio would like to thank NISAC for hosting these webinars and also providing us the opportunity to speak with everyone today. And we also want to take a moment to recognize and thank all of you on the call, the local leaders in each of the communities across the state. Whether you wanted to or were ready to, you became the face of your community response to this pandemic, and along with your staff, have maintained the continuity of operations for your local governments. So many thank yous to you for what you've done and will continue to do for your communities. I'm sure I do know many of you, but for those that I don't, my name is Randy Shepard, and I'm the head of the Bonadio Western New York Government Practice. And today I'm happy to be joined by two of my partners. Lynn Keck is a partner in our tax practice and leads our CARES and More consulting team and has presented on a regular basis in relation to the impacts of the various legislation that has been issued. Jeff Paley is also a partner and part of our healthcare tax exempt practice and is part of what we call our COVID-19 task force, which works with all of our offices and their clients related to COVID-19 matters. Now on to today's topic. We understand that county leadership regularly interacts with business community, and we wanted you to be more aware of the challenges being faced by and the opportunities available to your nonprofit organizations, your businesses, from retail to restaurants and mom and pop stores. So I'm going to turn it over to Lynn, who's going to kick this off, and then Jeff will close it out at the end. So thank you very much for joining us.
Good morning, everyone. We're excited to be here today. I'm going to kind of kick us off this morning and I'm tasked with giving you a little bit more insight of what businesses are facing right now and what type of federal government funding that they're going to potentially have received or look to be receiving in the next week or so. So many of you are familiar with the acronym CARES Act. I'm assuming a lot of you are tracking this new legislation in the House called HEROES Act, which has a lot more local funding potential. But essentially, the CARES Act was the second bill that went through the Congress and signed by the president to really help businesses get through this difficult time. So essentially, there was a variety of different legislation pieces built within the bill, but the one that is most popular and is being most talked about by your businesses in your community, I'm sure, is called the SBA Paycheck Protection Program. And so the Paycheck Protection Program, often referred to as PPP, is a small business administration oversight loan program that essentially the banks in your community were tasked with administering and getting out to your businesses in your area. So you could see in the program's first round, there was $349 billion. It depleted rather quickly, and there was I'm sure you heard in your communities, a lot of frustrated businesses who didn't get under the first round. And then essentially the lawmakers passed an additional $310 billion, almost doubling the funding on April 27th, and still today some of that exists. So we're going to go to the next slide, and we're just going to show you a little bit about where these funds have ended up. And so why I bring this up is because I think it's important to note that even though New York state and city especially is somewhat considered the epicenter of the coronavirus in the United States, less than 20% of small businesses, this graph is based on the first round and I believe updated for the second round, but may only be for the first round. Less than 20% of small businesses have been approved to receive the PPP loan. And what we actually have seen is when you look at where the loans are going, it actually seems to be provided larger in the Midwest states on a per small business basis. Hardest hit areas like New York, New Jersey, Michigan, and Pennsylvania actually haven't received per small business the amount of loans that we're seeing provided in the mountain and the Midwest states. And some people think that that's linked to a little bit about the already existing ties that existed between the banks and the businesses, and that in some of the hardest hit states, there wasn't that existing relationship between the banks and the businesses. And unfortunately, that has prohibited them to get into the line of the PPP program. So we're going to go to the next slide. And in the next slide, we show you obviously things you already know, but just to highlight the hardest hit industries who are receiving more funding. So you'll see, the food service industry, we obviously know is an extremely hard hit with what's been going on, but it kind of ranks for you. The amount in blue is the amount that was lent in billions of dollars. Again, this is across the United States, not just New York. The change in the unemployment rate, and then the estimated number of layoffs per that business. So the gray number is extreme in the accommodation and food services industries, and we knew that. Essentially, we do see that the construction industry did overall as an industry subset do well in this area of receiving funding. Similarly, you'll see a spike in the manufacturing group and the healthcare and social assistance group when compared to the estimated number of layoffs or their change in the unemployment rate. So, but obviously the one most hardest hit we're seeing is the accommodation and food services. So we're going to go a little bit into very basic discussion. We'll go to the next slide as to who is eligible for this PPP program. And I think it's important for you to realize that the CARES Act essentially broadened who could get into the Small Business Administration program. You might have heard this thing called EIDL, SBA EIDL program, which is an emergency disaster relief program, but it was very limited as to who could actually get into that. And so the CARES Act expanded who they were going to be helping during this crisis. And so now they said, well, we're going to include 501c3 nonprofit organizations. We're going to include business concerns, which was a broader interpretation than what currently existed under the SBA, veterans organizations, and even tribal businesses. Generally, there's always exceptions. We don't want to get into too much of the detail, but when you're looking at your community, if someone had employees less than 500, then they're generally going to be able to get the PPP loan. What's interesting is we did have a lot of nonprofit organizations, and I'm sure Jeff will speak to it later, who were prohibited from getting into the PPP because they weren't a C3. They might have been a C5 or a C4. And so the first step was determining whether you were eligible. You would think based on what you're seeing on your screen, it's pretty black and white, but it was actually quite gray, and it caused a lot of confusion, and the SBA was very slow in providing guidance. And so we actually have worked with some clients who received the PPP loan and then later found out they didn't necessarily or should have received it or received a wrong amount and sent funds back to the bank, believe it or not. So it wasn't a crisp and process. Generally, the amount that your businesses in your community should be receiving should be based on salary that they paid or payroll that they paid in 2019. And so, for example, if someone in 2019 had payroll of $1.2 million, then they would divide that $1.2 million by 12 to say, what was my monthly payroll? And that'd be about $100,000 a month. And then the second piece of that was to multiply it by 2.5. So their maximum loan amount in my general example would be about $250,000. And when you think about that, that was the intention of the bill, was to provide people funding in crisis mode for about 8 weeks. I mean, essentially they were saying, we think we're going to be better off in 8 weeks. And, obviously we're past that 8-week timeline right now, but they wanted to essentially give them some cash to get through this 8-week strapped period. So if we go to the next slide, we're going to learn that you might say, well, why would my businesses be excited for $250,000? Well, obviously they were excited just to have a cash influx of money. But the biggest driver of the PPP program, as opposed to other programs that might be out there, like the Main Street Lending Program and the EIDL program, is that they don't have to necessarily pay back all the proceeds or all the principal amount that they borrowed. So in my example, the $250,000, I can actually get the bank to say, you don't owe me that all back. We're going to forgive it, provided that your businesses track certain expenses 8 weeks after they receive the loan. So they're very in tune right now to when did I receive my loan and when does my 8-week start of tracking expenses, because to the extent I can track and get this formula done correctly, and it really is a formula, and maximize, I might not have to pay any of that $250,000 back, which is a great stimulus to your businesses. The eligible costs that they're allowed to use this money for is payroll costs, interest on mortgages, personal and real property, interest on covered rent obligations, which just means rent payments, and that means a rent agreement that you had before February 15th, and covered utility payments, which could include telephone usage, electricity, gas, and is quite expansive. So this is what the actual CARES Act says. So many people thought, well, yes, I can spend $250,000 on those items. But if we go to the next slide, there was a little bit of a hiccup that came into effect. And it's not actually written in the law. And there is something going on in the House right now saying that they think it was unfair that it was subsequently provided. But the Small Business Administration really wanted to tie this loan to payroll. So if you remember the name of the program, the Paycheck Protection Program, they were trying to ensure that payroll was paid out during this 8 weeks. And they really were trying to stifle people, putting people on unemployment. And as we've gone through this process, while I see the intent and the reasoning, we really haven't seen that, right? If people weren't necessarily have employees who were being productive, that didn't prohibit them to say, I'm going to keep them on the payroll because I have this PPP loan. And I believe some of that mainly is because the time in which they had to make that decision was not the time they had their PPP loan. So oftentimes the PPP loan came weeks after the time in which that decision had to be made. And so they did, and there was so much uncertainty regarding the PPP loans because the first tranche of funding went so quickly. So essentially, the SBA came out and said, not only can you pay your rent, your mortgage, your utilities, and your payroll, but we're going to add an additional limitation and say to get the maximum amount of debt forgiveness, 75% of your principal must be used towards payroll. And so when you think about, when we saw in that previous graph that our restaurants and our service industries are the hardest hit right now, and they receive PPP funding, the problem is they don't have anybody to pay because a lot of their operations are closed. And so they're concerned about their ability to get this debt forgiveness. And so so in my example, I had $250,000 loan amount. 75% of that has to be used on payroll. And that's not the only limitation. Then they go in and they say, okay, so now based on this formula, maybe you say I only get $150,000 of debt forgiveness. And you say, okay, well, at least that's something. But then they start measuring your full-time employee equivalent. So I just want you to think about it as your full-time employees for simplistic example. And they start looking at pre-COVID testing periods and say, how many were on your payroll then? And how many were on your payroll during the 8 weeks after your loan origination date? And to the extent we saw it decrease, then essentially we're going to decrease your debt forgiveness even more. So your community members are feeling pressure right now to get people back into, existence, into employment, which, as all of you know, there's a lot of struggles from a variety of different areas regarding that. But one of the ones is some of our employees out there, we've heard, don't want to come back to work right now because they're making more off unemployment. And so employers are struggling with that. Other employers are saying, I can't really bring them back to work. I don't have anything for them to do. Again, especially in our service line industry place right now, because we're not opened up back in New York State yet fully. So these are all things that your businesses are struggling with, and to the extent that we can help them within our local governments to help them facilitate plans that would bring employees back, I think could be very useful. The other way that your debt forgiveness can be reduced is not just looking at your FTEs or your full-time workers before COVID and after, but also they say if you drop salaries, So some people said, well, we won't lay off, but we'll just decrease your salary and essentially try to hold the line with who we have. And they're again going to decrease your amount of debt forgiveness to the extent you didn't keep their salaries whole. The biggest thing I want to point out to this group is that those last two reductions, so if you didn't keep your full-time employees ramped up because you couldn't, and you might have decreased payroll because you had to, within the law that is written today, if by June 30th, so this is like the magical date, and there is potential it could move based on certain legislation in the House right now, if by June 30th your businesses can deplete those reductions. So say I had a full-time employee reduction, I had to lay 5 people off. If I can bring those 5 people back by June 30th, they won't reduce my debt forgiveness for that decrease. Same thing with salary. If I cut 10 people's wages and I bring them back to full-time wages by June 30th, they won't cut your debt forgiveness for that. So June 30th is this magical date. But again, as things progress, at least in New York State, you know, our businesses are quite concerned about it because, you know, they don't know if they're going to be fully ramped up by June 30th. So if we go to the next slide, it's a simple example. Oh, we're going to go back one. Sorry. So I just, through numbers, assume we received a $500,000 loan on April 22nd. My time is ticking, right? I have until April 22nd to June 17th to spend that money on eligible expenses. And let's say just based on the time period, unfortunately, I could only pay out $250,000 in payroll because I just didn't have people in the business working at that time. Essentially, I paid $100,000 on things like rent, things like utilities, things like mortgage interest. And so I'm looking at the bank saying, I'm going to get $350,000 forgiven. Essentially, the bank comes in, though, based on the SBA guidance and says the maximum that we can forgive to you is $333,000 because at least 75% has to be spent on payroll. And so they lost, right, not a significant amount, but enough during these times, a haircut of about $20,000. So that's the first test in what I was explaining to you. Now, if we go to the next slide, we'll see that the second two tests are saying, did you have a reduction in your full-time employee count? In this simplistic example, I said, yeah, during, pre-COVID, I used to have 50 full-time employees. During the 8-week period, now I have 40. So I had a reduction of about 20%. So in this example, not only would I not get $333,000 approximately forgiven, they would cut it again by an additional 20% because my full-time employee equivalent count went down. So now I wanted 350. I originally got cut down to 333,000, and now I'm down to 266,000. Well, now we're talking about significant dollars for this debt forgiveness. And so many businesses are looking to say, but can I get back by June 30th? So in this example, if this company could say, I can get back up to my 50 account by June 30th, then now their debt forgiveness would go back up to that $333,000 approximately. And that's a savings of $67,000, which is significant. And so part of our responsibility is trying to figure out how can we get people back to work. And I know it's not just it's everybody's responsibility, right? It's a big question mark out there, especially for states that are being slower to open up. So if we go to the next slide, I just, this has been updated today and I realized it, but this was as of May 2nd. And I just would share over the year percent changes in unemployment claims. So obviously we've seen the North Country, so that's where I'm originally from. I'm from Potsdam, New York, has jumped to 804%. The Finger Lakes region is 939%. Western New York, not as significant. Long Island, not as significant, but growing based on the reports issued today. But you'll see that, this is plaguing all of us throughout New York State. If we go to the next slide. Here, it's again more statistics that show you the latest week, the previous week, and 1 year ago. So, I mean, it's nothing that you all don't know. I'm very well aware that you know this, but I just, these numbers, as we all know, are staggering. And so when we talk to the governments, I think there is an interplay between helping small businesses with that, magical June 30th date, and helping, counties get people back to work, and also tying in potential revenue generations that could occur that would help the county as well, which obviously, restaurants and service industries are huge sales tax revenue raisers, which affect our overall counties as well. So we're going to go to the next slide. This again is just now breaking it down by industry. You're welcome to look at it, in the future, but I don't think it's anything that you already aren't aware of. So the next slide. The other few things I just want to mention before passing it over to Jeff at a high level is there are payroll credit incentives, and I hope you are all aware of the payroll credit incentive for OASDI. So usually that's about 6.2% that the employer is paying on behalf of their employee, and this is open to governmental agencies. So for example, if you have as a federal, and I want to make clear, it's open up to everyone. So now it's open up to your businesses in your towns as well. But essentially, you're allowed to defer your 6.2% payroll tax. And so between March 27th and December 31st, think about it. If you have a $1 million payroll, 6.2% of that could be deferred until December 30th. 50% would be paid on December 31st, 2021, and then another 50% would be paid on December 31st, 2022. When I talk to people about this, I say it's a 0% loan, right? It's a 0% loan, and you do ultimately have to pay it, but it allows you some cash liquidity during a time in which you might need it. Right now, as it currently exists, although the House bill currently called HEROES is trying to overturn it, for your businesses that do have a PPP loan, they can do this. They can keep anything deferred up until and keep it deferred until 2021 or 2022. But once they get the PPP loan debt forgiveness certifications from the bank, which to be honest, I don't think would be until September based on timing requirements, they couldn't defer anything after the time in which they got that document from the bank. But this is a cash flow stimulus type of item. The next slide shows you some other items that are also probably being talked about in your communities. Again, employers with less than 500 essentially got under the Families First Corona Response Act, which is acronym FFCRA. They also got told essentially that they needed to extend their family paid and sick leave. And by doing so, they could receive a credit for the wages in which they paid. And so there was a variety of different reasons you could be sick. And then the extended family medical leave was if you had to be at home because essentially the schools were closed and you had no child care. So those, again, are payroll tax credits that if your employers in your community, your businesses in your community are having to extend that requirement or that paid leave, they do get an offsetting payroll credit, of course, with limitations. And then the other item that you might be hearing a lot about is about the employee retention payroll tax credits. I will say in general, this is really for our larger employers in our area. So for Rochester, I would think, the Xerox, the Kodak, the larger companies of the world with 500 or more employees, because essentially if you received a PPP loan, the employer retention payroll tax credit is not available to you. And unfortunately for governmental entities, neither of these credits are available to you at this time. But again, the bill that's in the House called the HEROES Act would open up some of these credits to you for governmental entities. That is in the House bill. Before I pass it over, I'm going to tell you, which you probably already know, the House bill is somewhat contentious right now. Republicans are not fully supportive of it. We do have some budget hawks who are saying in the Republican Party that it's too much. And there is some disagreement about some of the items that are in there. And the overall, feeling we're getting from the DC government, and you probably know more than me, is essentially there is no rush for this fourth bill. And so we'll have to see how that proceeds. So now going to the next slide. I'm going to pass it over to Jeff Paley, who's one of our well-known not-for-profit experts in the firm, to give you an update on, you know, the non-for-profit organizations and how they're addressing this.
Thanks, Lynn, and thanks everyone. Good morning. It's interesting that a lot of the elements of the CARES Act actually expanded some of these programmatic funding sources to include not-for-profit organizations, but sometimes it was on a selective basis. So when we talk about non-profit organizations related to some of these relief efforts, for most of them, we're talking about 501c3 and 501c19 organizations. 501c3, of course, being public charities in general. 501c19 is veterans organizations. But some other organizations, like, for example, a Chamber of Commerce and a number of other tax-exempt organizations, are not eligible for some of these things. So there's kind of a selective element to this. There are a lot of different programs available. Lynn went through the primary ones, and certainly the ones that most of your constituency is going to be taking advantage of, or certainly trying to take advantage of. On the nonprofit and healthcare side, particularly when we're talking about healthcare, there's been broad understanding that hospitals and healthcare facilities are being stressed throughout this period. So there's a lot of specific funding for them, cash flow assistance, I guess I would say, some of which would be repaid or recouped later, and others which would not be repaid or recouped later. So we've listed some of them on this slide. I think there's a variety of engagement on these within the nonprofits that are going to be located in your counties and operating in your counties. And most of these things are the same things that Lynn went through. I'm not going to repeat all of that. One of the other elements here, though, on the nonprofit side, is that there are a lot of nonprofits and corporate giving programs that have sprouted over the last couple of months, foundation giving that can really involve some very significant dollars. And one of the things we're trying to do, and one of the things that is of benefit to your constituency, is to just keep an awareness of these things. Frankly, there's a flood of information about some of these things, and it can be really hard for especially smaller nonprofits to keep up with it. But nonprofits in your communities are definitely taking advantage of a lot of these elements. If we go to the next slide, I want to relate this back to what it means to you, because when they indicated, when I was invited to speak to this group, there was one thing I really, really feel is important to talk to county government about, and it's generally referred to as the double dip. And go ahead, go to slide 18. The double dip is this concept that many nonprofit organizations have funding contracts with counties or with the state that fund specific positions. So an example might be, I work with clients where they have a contract with their county to do, let's say, foster care placement services. And so that involves essentially, in many respects, operating the foster care program within the county. And the contract with the county for that program funds specific positions. So maybe the contract says we're going to fund you for X amount of dollars, and that's supposed to cover 4 positions, salary and benefits. So during this 8-week PPP forgiveness period, as Lynn just described, these employers are eligible to get their payroll covered by the PPP forgiveness for 8 weeks, which is the same dollars that the county contract is funding for this particular program. If employers in the nonprofit sector believe that they cannot get reimbursed for those same payroll costs from 2 different sources, this is referred to as the double dip. So if they take all their payroll for the 8 weeks, including the 4 positions that are covered by their county contract, and get it reimbursed through the PPP forgiveness, that would be called double dipping. And generally speaking, nonprofits who have these kind of contracts with counties believe that double dipping is forbidden. I want to point out one thing about that last bullet on this slide, and I want to point it out as a theme through the next few slides. I want you to notice how many times the word assumed is included in these slides. This is a very real situation that I'm going to describe to you, but there's a lot of assumptions involved in this. And at the end, I want to sort of point out that perhaps there's an opportunity to take some of the assumptions out of the equation and be a little more clear on what's going on here. So if we go to the next slide, one of the key issues here is that there's been very little actual guidance from the traditional funding sources at the state and county level about the double dip. Some of you may be disagreeing with what I just said because it's not consistent across different counties. It's not consistent across different funding sources at the state level. So there is some guidance, but in many cases there's very little guidance or no guidance. Most nonprofits assume that if they get reimbursement from PPP, they will not be able to claim the costs under their existing county contract because of the double dip. They don't want a double dip because they understand that to be forbidden. Whether that's true or not is not totally clear, but that's their understanding. So the element here is that if a nonprofit provider has expenses that are eligible to be reimbursed through both channels, they understand that if they don't get reimbursed for those payroll costs through their existing county or state contract, that when they go to renew next year for that same contract, part of the basis of the amount of next year's contract is going to be how much they claimed under this year's contract. And the concern here is that they're going to have a reduced contract next year simply because they claimed those payroll costs under PPP for 8 weeks instead of claiming them under the contract for the 8 weeks. So if we go to the next slide. So the assumption here is that if they take the PPP money for this payroll, for the reimbursement of these payroll costs, it's going to hurt them down the road. It's a long-term detriment to their operation. And therefore, they're concluding right now that it's going to be better to turn down the free federal money and take the money from the existing county or state contract instead. So the effect of this is that you literally, in your county, have employers who are turning down free federal money on purpose that they are completely legitimately able to claim because they don't want to have their future contracting with you hurt in future years by not claiming the full amount of this year's contract. And keep in mind, this is under the context of statements from the governor and others at the state that the New York State budget has been severely hurt financially by the COVID-19 disruption, that there's incredibly large deficits in the multiple billions of dollars at the state level, and that funding is going to be very difficult to come by going forward already. So these not-for-profits are saying, I don't want to do something with this PPP program that's going to make it even harder to secure my funding on these contracts going forward. So if we go to the next slide. So what's the effect of this thing? And this is real. How many millions of dollars of free federal money is being turned away by not-for-profit employers in your county? I don't know. There's no tracking of this. I know it's a lot. And when we think about it at the state level across all the counties, it's billions of dollars that nonprofits are going to simply just turn down. And the real question is, would your county be better off if these nonprofit employers accepted as much PPP money as they possibly could and went for forgiveness on these loans to the maximum extent of their payroll instead of taking out payroll that's also covered by a county or a state contract? Across the state, this has got to be in the billions of dollars that is on the table, and that not-for-profit employers are going to consciously, purposely not take from the federal government, and it's not going to flow into New York State because of this. I believe there's an opportunity here. If we go to the next slide, I want to point out again, there's a lot of assumptions in this double dip scenario. The assumption that double dip is prohibited, the assumption that if not-for-profits don't claim the full amount of their current year contract, it will negatively impact their future year contract. There's assumptions about the timing of payments and the recontracting process in general assumptions about the state budget, and it's very difficult for nonprofits to make judgments about all these assumptions they have to make, but in most cases, they're assuming essentially the worst related to future contracting, and they want to put themselves in the best possible position, which generally leads to the conclusion that they should not take the PPP money for these positions that are covered by county and state contracts. So the question for you, not to put you on the spot, is can you at the county level provide some assurance to these nonprofits who you've contracted with for a variety of services that they are not going to be hurt in the future on contract renewals if they take the full extent of PPP funds? Understanding that at the county level, a lot of the money that you're contracting with these organizations for is essentially received from the state to the county, and then the county contracts with the nonprofit. So is it possible at the county level to provide those assurances? Is it possible to somehow communicate with folks at the state level to provide some of these assurances? In the current environment, I know this is a big challenge, but there's a lot of money on the table here that's, again, federal money that could come into your county, into our state, that is going to be purposely turned down by these employers. We don't have a lot of time because the PPP program, there's an 8-week period to spend the money, and then there's a short period after that to file your claim essentially with the lender on how much forgiveness you're trying to claim. And if these not-for-profit employers are going to have to decide for once and for all if they're going to include or exclude the payroll dollars related to these positions that are covered under county and state contracts. And that those decisions are going to be made starting mid-June and going through July. So there's not a lot of time. There is time, but not a lot of time. If something's going to be done about this, it has to happen very quickly. And I think I would pose it to you in terms of, is there the ability or the willingness to take action on this at the county level? Why don't we go to the next slide? Thank you. So that discussion is important, and I think it's worthwhile to think about. The other thing, this is a kind of a coming attraction that we wanted to make you aware of. This thing called the Main Street Lending Facilities. This is a partnership between the Department of the Treasury and the Fed at the federal level to make a loan facility available to larger organizations. Remember, the PPP program was for small businesses. It's administered through the SBA, and it's really designed for employers with fewer than 500 employees. This is for larger employees with up to 15,000 employees or up to $5 billion in revenue. And their eligibility requirements are really that you're a US company and you pay taxes in the US. And it makes low interest or moderate interest loans available on an emergency basis that the Fed would then purchase and essentially provide the cash flow to fund. If you go to slide 24, it's important that your constituencies understand this, especially if they were locked out of the PPP program because they're too large. This Main Street Lending Program has 3 options within it. One of them, the first one is basically an unsecured loan, so there's no collateral required. The second one talks about taking additional loans that you have and rolling them into a new loan at these advantageous terms. And then the third one talks about with collateral, you can actually have a different arrangement and higher loan balances. So the key differences between PPP and the Main Street loan is that the forgiveness element of the PPP program does not exist in the Main Street lending program. So that's obviously a major difference. But if you're too large to qualify for PPP, the Main Street lending program is definitely available. I should not say it's available. It's rolled out and it's defined. The actual process of applying for loans is not available yet because the banks and the regulations and process for banks to do this haven't been defined yet, but it should be coming and opening up very, very soon. It's important that your constituents, especially if you're dealing with constituents who didn't get a PPP loan, understand that this is available. It's very advantageous terms, LIBOR plus 300 basis points, 4 years, and loan amounts that vary based on your income, more or less. if you go to the next slide. And then you have no payments for 12 months, which definitely helps from a cash flow standpoint in the current environment. And again, there's no forgiveness. One of the caveats about the Main Street Loan Program is that there's restrictions on executive pay as well as dividends and stock buybacks. So if you're dealing with larger sort of publicly traded companies, some of those restrictions can be onerous to some organizations. So it's important to understand those details. But certainly there's more money involved in this because it's aimed at larger employers. Important to know that that's coming, and it should really be rolled out very soon in terms of being able to actually apply for and receive funds through the Main Street Lending Program. Next slide. I think that's it. We stayed almost exactly on time. My clock says 10:43. I think we're into our question period.
Well, thank you very much, Jeff, and thank you, Lynn. At this point, if you have any questions, the audience or our participants, I would ask that you please submit those questions on by chat on the right-hand side of your webinar screen. So the first question I have is for Jeff. Jeff, you talk about the assumptions with the double dip, but you didn't say whether it is permissible or not permissible. So is the double dipping permissible?
Well, it's an interesting question, and this is part of the reason people are making assumptions is that the answer is not entirely clear. One of and there's two factors to that. One is the PPP program. It is totally permissible. The PPP program does not care about your other revenue sources. It really only wants to know about your payroll expenses and your other eligible expenses. So it's totally focused on the expense incurring of expenses during the 8-week period. Other funding streams from New York and from counties do not necessarily address this question. So you might have a nonprofit who has a contract and they've had this contract renewed for 25 years, but there's no language in there that says if an emergency funding source from the federal government arises that will cover some of these costs, you cannot double dip. There's just not language like that in these contracts. So these providers, these nonprofits who are operating under these contracts don't have a clear answer. We've talked to many nonprofits who've reached out to their contact at the county or their contact at the state who's involved in these contracts and these programs, and those people either don't have an answer or they give the answer that, well, of course you can't double dip. There's no actually authoritative guidance that says you can't double dip, but somebody somewhere said you can't double dip, and that word spreads because these nonprofits talk to each other. So that has become the assumption that you can't double dip. The other interesting element at the New York State level and at the county level is that you have different departments who are giving different answers. So you might have, maybe there's a person at SED who says you can't double dip on their contracts that their funding is related to, but another person who's involved in, let's say, a substance abuse program at Oasis who has a different answer. And so nonprofits are confused by the sort of variety of takes that the different folks have within the infrastructure in New York State. And so that's why they're making assumptions, and most of them are making the assumption that they just can't do it because the risk that they can't do it exists, and they don't have a clear answer that would indicate anything else.
Okay, thank you, Jeff. So on the same line, a question that says, is there a possibility that the county could save contract dollars in the current year by the amount of federal funding through the PPP for one of their contracts with a not-for-profit in their community? So in other words, so a county may not be getting funding from the state even for their existing contract with a not-profit in their community because the state has started to slow down their reimbursement or funding to counties. Can the county save money on that contract by encouraging or by offsetting their contract dollars with the PPP?
If the county, to some extent, that's a legal question, but I will tell you that if the county has the authority to tell the nonprofits that it has contracted with that they should maximize their PPP reimbursements and therefore claim less on their county contracts, that is a path that is worth investigating. The key element there is that the nonprofits are concerned that if they claim less under their county contract this year, that next year is renewed, and when they go to renew that contract for next year, they're going to get less money because they claimed less money this year. So I would suggest that a county who's taking that path to tell the nonprofits that they've contracted with to maximize their PPP funding and claim less under their county contract should couple that with a commitment that they're going to work whatever angles they can to ensure that next year's contract gets renewed for the full amount and not the reduced amount, because this PPP thing is, let's hope, not going to recur. It's a 2020 only thing. Does that make sense?
Or Jeff, another way it might to say it is that when they're re-looking at the contract, they would include funding that was used on the PPP loan for purposes of redetermining next year's contract, meaning it wouldn't be ignored, right?
Correct.
And I guess
so in that way, the county gets the advantage of the cash flow currently, but the nonprofit doesn't have to worry about their cash flow in the future. That's the way to make it a win-win.
Yeah, understood. And I'm speaking on behalf of the counties on the line, which is there's still a number of questions at the county level about what will be available to counties through the federal and state government budgets over the next 18 months. So an assurance like that may be difficult for a county to provide their nonprofit partners at this point.
But could the assurance be that you would allow, I guess the one question I would have is not to say that you'll keep the existing contract, right? Because you're always going to be basing your contracts based on the funding that in which you have, but that the use of the funds towards PPP wouldn't be detrimental towards the computation of their contract. That's what I was trying to articulate earlier. Meaning, okay. I think that's the wording that you could use or say you're committed to. Because I do think it's significant about what Jeff was saying about essentially it's allowing the federal government to subsidize those contracts and allow, and allow some of that pressure to come off the counties and the state.
Okay, great, thank you. So there's a question about the second round of PPP. Are nonprofits or any businesses in our communities, are they still able to apply for PPP, or is that new fund been extinguished?
Go ahead, Jeff.
Oh, the latest round, there still is some money there, and it's almost, I think it's almost 100 billion. A couple days ago, it was just over 100 billion still left in that program. Part of the focus of that has been to make loans to much smaller organizations. And so there's more loans, but fewer dollars in each loan. So the fund is still there. You can still apply. It's still open, but there's no promise of how long that's going to be the case.
Right. Okay. It's taking much longer for the second round to be utilized. And I think a lot of that has to do with a lot of the rules that were issued between the first and the second tranche that kind of tightened up who the true beneficiaries should be of this loan.
Okay, great. Thank you. To Lynn, back to the map, the slide with the map of the United States on it that showed that there was heavy use of the PPP by Midwestern states and really not as much use by companies or businesses in New York. Is there a reason for New York, why New York companies did not take advantage of the PPP as much as companies or businesses in other states?
So it's actually quite interesting that, yes, the study that this came from, and I'd be happy to share the link further, is they were trying to track whether the use of the, they tracked three main target areas. One were the applications of the PPP funds and the people who receive them based on unemployment ratios and based on hardest hit COVID areas. And the trending with both those unemployment increases and indeed, the hardest hit areas of COVID, it didn't trend correctly with those two, meaning the higher the COVID, the higher the unemployment. It did not trend with the higher, the more the PPP funding they got. And what it actually did trend with, which I alluded to earlier, was the relationships that small businesses had with banks. So essentially, of course, I would not be surprised that there were more small businesses in New York than some Midwest states because the population is much higher. But what we did find is that there's a lot of small businesses who didn't have a consistent relationship with a particular bank. And when the PPP funding was provided, most banks only would allow people who already had an existing relationship to apply. So that meant that if I didn't have a relationship, and I'm just using, I guess I'll say XYZ Bank, if I didn't have a relationship with XYZ Bank, or I had a relationship with no bank, I kind of was on the outskirts of getting into this loan facility. And I think what the study found, and it's a preliminary study, is that surprisingly, the states who probably needed it the most because of high unemployment and being, high COVID cases, were actually limited because of banks requiring there to be a relationship with the bank in order to apply.
Okay, great. Thank you. One last question. I invite any of the participants who have a question to submit them. The one that I have, the final one, unless I get another one, is you referenced, Lynn, a number of times, and Jeff, how county leaders who are on this call and county leaders who may be listening to the recording after this webinar, how they can help their small businesses and nonprofits. I think we covered how we can help the nonprofits, but how can we help small businesses gear back up in terms of hiring their employees back by the June 30th or the 8-week deadline to maximize loan forgiveness?
Yeah, I think that's a great question. And I think, what we've been doing with some of the consulting that we've been helping them with is I think for us, that has risen to the top. The unemployment is a significant issue. And so when you look at the trifecta, in my opinion, for counties, is one, how can I safely get my businesses back to work? 2, how can I ensure the safety of my citizens, which ultimately will help me make sure that my hospitalization doesn't spike for COVID? And 3, how do those interline with potentially increasing, or getting my revenue stream back to normal for my county government? So I think, there's a variety of different ways that you could do that depending on what is your highest industry in need, right? So for many of you, it might be restaurants, right? So we've been talking to people about ways that even though ways that you can ensure and maybe redirect people that you currently use to help the restaurants understand how to open back up. Simple things like how are you going to disinfect? How are you disposable restaurant menus, disposable, whether or not you're going to require masks? How are you going to sanitize at night? All of those things. And then to the extent there's any funding available, that might be where you redirect potential help. Not saying I'm going to pay for your food, right? But I'm going to pay for these additional costs that you probably haven't had to deal with in the past. And so I think that, and then in turn, can be promoted by the counties ultimately to the constituents of the county about safe places that have worked with the county to ensure proper and safe opening up of facilities. And so when you look at it, like in the Midwest, that might be food packing plants, right? Because that's, for us, it could be restaurants. For other people, it could be car dealerships. I mean, but it's all kind of based on your particular climate within your county. But I think that's the trifecta: is the health of your citizens, the safe reopening of businesses, and starting up the revenue stream for the county government. And any solution that hits all three of those is going to be a strong solution.
That's a good way to put it, Lynn, and I think we'll end it right there. We are looking for that trifecta as we approach the reopening of some of our regions, our counties in 4 regions, which are preparing to reopen tomorrow or the day after tomorrow. So I want to take this opportunity on behalf of NYSAC, Stephen Aquario, our executive director, Jack Marin, our president, and our board of directors, to thank you, Randall, and Lynn, and Jeff, for taking your time and lending your expertise and experience with NYSAC and our members today for this webinar. We appreciate your time and attention to all the participants on today's webinar, and we appreciate you all continuing to support NYSAC and the work that we're doing on behalf of New York State counties and New York State county property taxpayers. Thank you.
Thank you.